Recipes for technical trading success in Cook's Kitchen.
What's the probability of a recession right now? And this is a big, important question because we've got a stock market that's been going sideways for 6-7 months that looks like it's starting to roll over. All right, I'm going to show you my recession probability tool, my indicator that I use, which is bumping up against a 20% chance of recession in the next 3 to 9 months. First, let's a quick few words about market breadth. I should have talked about it last week. It's become a factor as we see the market roll over. And there's a lot of different things we can look at. We can look at the percentage of stocks above their 200-day moving average. We can look at how the advanced decline line is working, you know, the cumulative advanced decline line, and if it's starting to roll over. We can look at new highs versus new lows. Always a good measure, even though that tends to ebb and flow. When it really starts to increase, you start to worry. I'm going to show you one of the simplest indicators for market breadth. It's one chart. You can bring it up anytime. And that is the S&P equal weight chart. Here on stockcharts.com, it's SPX EW, with an EW after it, obviously. This is a 2-year chart, a daily chart, so those are the 50 and 200-day moving averages in blue and red that you see. And, you know, what do you see here for 2015? 2015 starts right here where my pointer is. Yeah, we've got this market going sideways. You know, we've got this bullish structure here that we found to be support. Market keeps bouncing off of S&P 2070. You don't see that level here, but this would about correspond. But on the equal weight chart, you see this rolling over here and spending, you know, we spent a fair amount of time in July below the 200-day moving average on the equal weight. Now remember, what's significant about the equal weight chart or the equal weight index is that, you know, Apple doesn't carry, you know, over 5%. Or 13% like it would in the QQQs. So every stock, all 500 stocks are equally weighted. And that way you can see, you know, you can't have a few big stocks, Google, Apple, Priceline, Netflix. You can't have them driving the index higher or holding it up while, you know, the other half of stocks are breaking down. Speaking of the other half of stocks, you can also look at a measure of how many stocks are, you know, in corrections or, you know, let's say over 10% corrected. Jason Gepfert, who does a lot of data analysis like this, internal stuff at Sentiment Trader, he noted earlier this week that 252 S&P 500 stocks are in greater than a 10% correction. Is that significant? It is, because we haven't seen a number that high since July of 2000. And often these kinds of market breadth corrections, where over half of the S&P is in correction mode, precede tops. It happened in 2000, happened in 2007. So that's why we want to pay attention to it now. Going back to my equal weight chart, another way to look at this is the symbol RSP. RSP is the Guggenheim ETF for the equal weight. And so, you know, ignore the prices and just really look at what is the price action telling you and you know, its own relative strength. I have been a bull this year and have remained a bull, but getting cautious now here as this market gets exhausted going sideways. You know, you could have a correction in time, a rolling correction, so to speak, but after a while, the market can exhaust itself. And if more stocks start to go down and you see some leaders start to break down, like Apple and my beloved Skyworks, then, you know, you have to wonder if the market's in trouble. And here we have the equal weight index really, you know, fighting to get back above its 200-day moving average. So something to pay attention to. And also, again, the number of stocks in their own correction, off by more than 10% off their highs. That's over half just over half the S&P right now. All right, let's talk about recession. I'm going to show you my recession probability tool. What I do is I take 10 economic and political measures, indicators, or threats, and I score them on a scale of 0 to 10. 0 is the most favorable for the economy. A score of 10 for that indicator would be the most unfavorable. Then I take the total scores to create a composite recession probability. All right, so let's jump right into that, and I'm going to show you how I scored this in Q2, roughly the spring. And I'll just tell you right out now, when I did this in October, I was at only a 7% chance of recession. So that's why we were big buyers of those, the Ebola correction, so to speak, down to 1820 in the S&P in October, because my recession probability was low. It was under 10%. But by Q2, actually mid Q1, I had moved all the way to a 17% chance of a correction, of a recession in the next 3 to 9 months because of the way my indicators added up. So I'm going to show you the math here. So here's my 10-point scoring of recession probability in the spring of 2015. Fed policy and interest rates gets a 1. Very low impact. Rates are going to rise, but slowly. GDP got a big -3. Why? Because we'd had, another harsh winter stalled the momentum, and we had negative GDP. Non-farm payrolls, big fat 0, meaning very little negative impact, very positive impact, despite the participation debate, about how, hey, the unemployment rate is low, but when you factor in the participation rate, we have a lot of people who are out of the workforce, so to speak. All right, number 4, the industrial data, the ISM survey, the PMIs, the industrial production. Had to give this a 3 because we saw in the ISM in particular a hard drop from 58 down to 52. Very fast drop here, and we're going to look at that chart coming up. Retail sales also gets a big 4, big -4, because, hey, the retail sales have been trending down, 5 months in a row. It was not good. It was not pretty. And where were the shoppers with this big tax break at the gas pump, right? So big concern there. All right, let's go to the next 5 things. Consumer confidence gets a 0 because consumer confidence is extremely strong. Global worries, had to give it a 3. You got China, Europe, Greece, war, deflation, whatever. EPS estimates. This was another, this one got a 3 because of the earnings evaporation of Q1, where we saw aggregate S&P 500 earnings estimates go from above 130 to below 120 for 2015. A lot of that was energy, but there was also some collateral damage to other industries and sectors, and those earnings estimates didn't pop back quick. I thought they were overdone, so that's why I was always a buyer of market dips in the first half, in Q1 and Q2, because I thought that putting 2015 estimates at $117 was far too pessimistic. And then we've seen them come back up, 122, 124, 126 even. So, that sets the table for more reasonable valuations instead of the market being close to overvalued. So the estimates have come back. All right, leading indicators, great, looking good there. Initial claims, obviously. So what was the conclusion? Why did my recession probability climb 10 points from 7% in Q4 14 to 17% in Q2 15? The things we talked about, the GDP drop. Hey, winter showed up again. Why does winter always do that? This is becoming a trend now, 2 years in a row of negative GDP in Q1 because of winter, something that has happened, I think, for the last 50 million years. All right, ISM survey drop. We talked about that. Earnings estimate evaporation. We talked about that, the great evaporation. And retail sales negative for 3 months consecutive. So that's why I went to 17% chance of recession. And so where am I now? Well, let's look at more recent data. This is the ISM Manufacturing Index as of the July data, which was just released, I believe, on Tuesday this week, here the first week of August. And you can see, hey, so here's the terrific 2014 surge in the industrial data. ISM, manufacturing's coming back, right? And we get all the way up here to 59 a couple of times in late 2014. And then, we come into Q1 and it's the energy meltdown, and then near recession levels on GDP. and we bottomed just above 51 on the ISM data here. Had a nice recovery in the June data, which got us back above 53, but now we slip off again. So this is not, so on the one hand, you would expect to see that decline we saw in the ISM data. The purchasing managers, they became optimistic. So you had that big run up. Of course it was going to fall back. So not surprised to see it fall back to 52 at all. What we want to see, and what I've said for months, is we want to see how does that bottom. Do we get a nice sawtooth bottom there in purchasing managers' optimism and their actual orders, hiring, all that stuff that goes into those surveys. And in the industrial production numbers, both the headline national number and the regional surveys, whether it's Dallas, Richmond, Chicago PMI. We want to see those, sort of grinding out some stability and a base above 50. Let me talk about a fund manager who sees a much higher increased chance of recession because of this kind of data. Guy's name is Raoul Pal, and he's a Goldman Sachs alum, writes some macro letter now that he must be giving Melissa Lee on CNBC because he's been on Fast Money several times on Fridays. So in June, he looked at this industrial data, so he was looking at the May data, and was alarmed. He was calling for a U.S. recession. And his numbers were something like, okay, if ISM goes to 50, that creates a 65% chance of recession. Actually, let me see this now. Oh, no. He said an 85% chance of a stock market correction if the ISM went to 50. Now, maybe he's right there. Now, that's the overreaction among investors, right? And we haven't seen that yet, but we didn't get to 50 either. And he said that the ISM at 50 would actually equate to a 65% chance of recession. That's pretty high. I don't know if I would jump to 65% just if the ISM hits 50, but we got to look at what else is going on. Now, this is historical data, according to him. So, and he says when the ISM hits 46, there's an 85% chance of recession. Hey, that's probably true. If you can't bounce off of 50 on the ISM or PMI data, you're probably in trouble. So that's something to pay attention to. I'm going to tell you in a minute where I am now on this. Let's look at the other big one. The other big piece of data is, of course, the retail sales. Not pretty. Still, you see this downtrend we've had since late Q4. Retail sales just keep coming down. Got a nice uptick, just like the ISM did for July, and then we're down here again. So the red line, this is from Bloomberg Econo Day. So the red line is the yearly retail sales, and then the monthly bars, which are going to be much more volatile. But hey, they make up the yearly cumulative. So retail sales, again, not looking good. So where am I now with my recession probability indicator? I would add a point to retail sales, which bumps it up, and I would add a point for the ISM industrial production data. So I've moved up my recession probability to at least a 19% chance of recession. And the earnings picture, hey, even though aggregate S&P 500 estimates have come back up to say 126, this earnings season, you're going to hear numbers like, hey, we got a 73% beat ratio, but remember the bar got really lowered again. So a lot of companies are beating that maybe wouldn't have had their estimates been in place, the estimates from 3 months ago. So that beat ratio, I'm skeptical about. What we're really concerned about is, where analysts going to take estimates now, where are they going to revise them now for earnings growth looking at the second half. And, and so as that washes out, I don't think that's a big boost either. So I could almost add another negative point to the EPS picture and get us to a 20% chance of recession. I think that's a comfortable number to work with. I'm not surging over a 20% chance of recession, but I think you want to view the economy and the earnings picture as having that sort of quality of being close to a 20% chance of recession. Whereas somebody like Raoul Pal, he's probably looking at the ISM data and wants to be at a 50% chance of recession. I'm not there yet. And what is the market telling you? We looked at the market rolling over. Other breadth indicators don't look good, besides the ones we talked about. And yet here the market is still, 2% off its all-time highs, trying to get back to 2,100 today. And so, here's my point: is that the market is a terrible predictor of recessions, right? It's called 9 of the last 4 recessions, as they say, sarcastically, but it does tend to run in fear right away. I mean, that's the side that the market errs on, is, hey, if the recession probabilities are climbing, let's have a correction. And we're not seeing that. So you have to wonder, and there's a lot of, information travels so fast. The money that moves the market, the big money, they've got teams of economists crunching all their own econometric data. They're not waiting for the Fed to tell them. And we get so much data in real time now that we didn't even 10 years ago, that they can plug this into their models. Every major bank can predict GDP, just like one of the Southern Fed houses has the Atlanta Fed has their GDP forward look, so to speak. Well, every bank can do that now because they get so much data in real time and can crunch it. And, I don't hear any of them saying, hey, I see a 25% chance of recession, or, GDP is going to bomb next quarter. So until we see that or hear that, and it's not showing up in the market either. All right. I think I covered everything I wanted to talk about. Oh, we didn't talk about the dollar. We have to talk about the strong U.S. dollar. Raoul Pal would say that that is also his bet for a recession, and his bet against the U.S. economy is that the dollar is just going to keep getting stronger, and it's probably based on the euro collapsing down to parity or lower. I think I remember him saying he's calling for euro 75 cents, or 2 or 3 years out. And so if the dollar strength trend continues, that could be an economy killer. I think it's an earnings killer for a lot of companies, and that could roll over into an economy killer, and then you'll see the ISMs and PMIs go to 50. And so who might be the linchpin for this? Janet Yellen, right? She's holding off. She's probably very worried about the strong dollar, and yet the Fed feels motivated to get off of zero. They feel, I say that the Fed is embarrassed, and some members probably are. They're embarrassed that they're still at zero after 6 years with what the market's done, with what the economy's doing, and they're anxious. They want to get off zero so it didn't happen on their watch. Well, what's that going to do to the dollar? It's only going to strengthen the dollar. That's going to roll over and impact the economy. So I think this is a time to be cautious with the market, with this correction in time going sideways, starting to roll over, and you've got these pressure points here with the dollar, with the ISM data, and the Fed sort of reluctantly putting their finger on the trigger to start a liftoff cycle. All right, I did cover everything. It was kind of long. Hope you enjoyed it. Go back and look at it. Make up your own recession probability indicator. But I think mine's a pretty good tool to get you about as far as you need to go to really have your own opinion about it. All right, thanks for joining me in the kitchen. We'll see you next week.